Today is Tuesday, October 14th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Mark Bowman, ADMIS Senior Market Research Analyst. And starting with the grains this morning, Mark, will the U.S. and China ultimately get a trade deal done?
At the moment, it seems increasingly unlikely it will happen anytime real soon. But ultimately, I think we will. Right now, talks seem to be bogged down on these tit-for-tat fees and other costs associated with each other's vessels using each other's ports and threats of higher tariffs and this and that. But ultimately, I think these are just tactics being used by both sides leading up to an anticipated meeting between President Trump and Xi later this fall. In the long haul, I think both sides got to think that it'd be beneficial for the largest and second largest economies in the world if they were on more favorable terms. Now, certainly, there's a lot more involved here than just soybeans, things outside the expertise of a grains analyst, with China wanting our most recent powerful AI chips and us wanting access to their rare earth metals. So the negotiations have been ongoing behind the scenes, and hopefully will continue to keep the lines of communication open before the presidents meet later this fall in South Korea. As of now, China has still not booked any U.S. soybeans for the 25-26 marketing year, and this is a time of year when U.S. sales typically dominate global trade. In recent years, China has already been buying twice to three times as many soybeans from Brazil than they have the U.S. And when you look at Chinese exports to the U.S., they've been in a steady decline too for a number of years now, slipping to only 14% of their total exports to the U.S. last year, down from 20% at the beginning of the century. And that's likely going to fall to 10% or less this year, given the heightened trade tensions and tariffs. So a lot is hinging on these upcoming talks, and hopefully lines of communication stay open, ultimately enabling us to come to some sort of beneficial agreement to both parties. It may not happen in time for us to salvage much soybean sales for the 25-26 marketing year. That window gets shorter every single day, but hopefully they come together over these winter months and can get some sort of agreement in place.
To trade or demand data might we see despite the federal government shutdown?
Yeah, despite the shutdown, we still should have access to some beneficial usage data this week. U.S. exporters, they continue to operate, and the USDA continues to gather this information and report it via the export inspections data. This week's data was delayed by a day because of the Columbus Day holiday, but bean shipments this week were a record, or a highest for the marketing year, bumped up to 36.5 million bushels. That was well above expectations. Corn inspections, on the other hand, they were weak at only 44 million bushels. Despite the recent slowdown, corn export inspections still off to a very strong start, up 65% year to date. Over a year ago, the USDA forecast is up only 5%. Wheat inspections were in line with expectations. We also expected to get NOPA crush data tomorrow. NOPA members now, over 95% of the crushers here in the U.S. are NOPA members, so it's a very reliable figure there. And also expect ethanol production data from the EIA on Thursday, also delayed a day this week as they continue to operate normally despite the federal government shutdown.
Thanks, Mark. Mark Bowman, get some cocoa numbers coming out this week. What are the potential implications of the third quarter cocoa grind numbers that are due out this week?
Okay, so they're due out on Thursday. These are important demand readings. They only come out every quarter, and it's about the only major demand reading we get besides the ICCO annual numbers. Then now the second quarter numbers confirmed a slowdown in demand and indicated that high prices were doing their job in limiting demand. Europe's was down 7.2% from last year during the quarter. Asia's was down 16.3%. North America was down 2.8%. And the market established a low after those numbers were released, and that low held for about 2 months until very recently. Now we currently have an oversold situation. We got RSI below 20. We got stochastics crossing to a buy signal from a low level, and this does suggest potential for some maybe short covering on any bullish news. We've also seen a steep sell-off on renewed rainfall in West Africa, which has improved the outlook for the main crop, which is in harvest now and will last into March. Also suggests maybe a buildup of soil moisture that would support the mid-crop next summer. And this will boost pod development as long as it doesn't get too rainy. And then there is adequate sunshine, and as long as the roads hold out, because they have a lot of dirt roads that can slow process. Now, Ivory Coast and Ghana increased their farm prices this year, which is expected to encourage farmers to sell their product. So far, though, port arrivals in Ivory Coast appear to be off to a slow start. Only 48,000 metric tons as of October 12 versus 100,000 at this point last year and 144,000 as a 5-year average. Regarding, though, keep in mind, the marketing year just began October 1st, so it's maybe a bit wary about reading too much into this. So we got these numbers on Thursday. They come in weak. We could possibly see a spike low. If they come in better than expected, it could maybe help the market establish at least a near-term bottom.
And lastly, Mark, an energy-related question for you. Why do you think the number of natural gas rigs are increasing as prices are falling?
Well, I think part of it is a long-term bullish outlook. The rig count last Friday showed an increase at 2 to 120 last week. This compares to 101 a year ago and above a 5-year average of 109, and the highest for this point in the season since 2022. Now, keep in mind, the high earlier this summer was 124 rigs, so we're still a little bit off of that. And we peaked at 1,600 back in 2008, but that was a different era. We've got more productive rigs now. We reached a daily record high of output just in August. So, we do have prices their lowest in September. December contract approaching 3.5-year lows. We've had unseasonably warm weather this fall, which is getting the heating season off to a slow start. We had mild conditions this summer, which allowed gas supply to increase. But we've got an expansion in LNG export capabilities by the U.S. We've had some trade deals that have been agreed to that include commitments to buy U.S. LNG by certain countries in Asia. And we had a slowdown in LNG exports this summer, but they seem to be back on the rise. So far this month, there's 16.3 billion cubic feet per day versus 15.7 in September. The record was 16 billion cubic feet per day in April. So we are off to if this holds, we'll be at record export levels. A long-term demand factor is still the increasing use of power demand for AI and for data centers. And currently, the U.S. generates about 40% of its power from natural gas.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.